I think you're confusing fundamentals with politics, Ben. I mean, I think a rate cut would be more politically motivated, in ahead of the midterms than fundamentally justified. Um, I really think that Trump is going to try something dramatic, related to rate cuts, affordability, housing. I'm starting to look at some very, very select real estate situations. I mentioned last week's Essex property, ESS. It's a multifamily play with a West Coast geography. And the multifamily starts are such that you can anticipate a shortage in 2 years' time. And Essex has big position in San Francisco and Seattle and the West Coast, and there's going to be a shortage there. And rents right now are much more justified. It's more justified to rent than it is to buy right now. So I think rental properties, multifamily rental properties, are going to be a place to be. I've also mentioned Flagstar, which is, we're starting to see properties move and clear at written down values, at least in the banking industry. They've been more aggressive than private equity. But so we're seeing a clearing, taking place. And so, turnaround situations like Flagstar, FLG, appeal to me. So, and obviously what I'm anticipating is maybe it's more for show than it is for, because Donald Trump is the master of promotion, but I'm expecting that they're going to do something on the housing front and the affordability front. I'm intrigued by the fact that Fannie and Freddie are I mean, I bought those, on the dip back in March, early April, and I'm up over 100% of my positions in Fannie and Freddie. So there's something going on that has got people looking at affordability as a theme, I guess. And I understand the difference between politics and fundamentals, and this to me is more of a political play than it is a fundamental play.
Yeah, but I think that I think politics are part of fundamentals now. I think that I was talking to somebody the other day, or maybe it was yesterday, the disconnect that a lot of people who were, grew up and operated in the pre-GFC when capitalism was very much alive, and the post-GFC, and especially the post-COVID in this fiscal dominance world and I had a long time where I struggled to adjust to it, is the reality is the government is heavy-handed. This is a manipulated, managed market. Like whether you like it or not, that's a reality. Okay, and it's just the free hand in the market. It just doesn't exist like it used to. Whether it's tweets or it's the Fed plunge protection team or just whatever. There's just politics are part of the game. And it just is annoying, but it's true.
Yeah,
You're right.
On a completely different subject, I just want to mention this quickly because I wrote about it this weekend, and that is, how you define a problem determines how big or small it is. And I learned this back in my days of following the Texas banks in the early 80s. When they started defining the energy problem as only 12% of their loan portfolio, it was very narrowly defined by the Texas banks. It eventually became 30 or 40% of their portfolio as the definitions changed and evolved. And that's kind of where I am with these private equity, entities. They're defining their problem, or the analyst community, I should say, is defining the problem as an NDFI problem or as a software problem. And any problem asset starts off narrowly defined and then grows from there as the cycle plays out. But one of the areas that I think deserves more attention as a potential problem area is the healthcare services area. And we had two, credits recently that surfaced in private equity. One was a company called Affordable Care, a DSO, Dental Service Operation Organization. And this is, there's no hard assets here. It's a service organization. And these service entities are just as vulnerable to AI as software is. And for example, I think there has been talk about AI setting up at-home care programs that allows a patient to bypass a hospital with just a periodic visit from a caregiver or a nurse. There have been some, I know one of the things that private equity has been having trouble is exiting some of their life science investments. And that's because AI has, created some life science startups. There's also regulatory issues as well, but it's causing problems in the life science area for the private equity. And I've heard, and we'll see where this ends up. The banks are now in the process of reviewing their healthcare portfolios, not just theirs, but the ones that they've lent to in the private equity space. And so I did do a sort of a review, a search of some of the major healthcare lenders. It's not a huge piece in the private equity, but you're starting to see names in private equity that are related to healthcare services being written down. Some of the names I wrote about this weekend were Affordable Care, AmeriVet Partners, Path Group, Pet Vet Care Centers, and Dental Care Alliance, in addition to some of the other names I mentioned. And there was a medical device company as well that surfaced as a very public write down for some of the private equity names. So the idea that AI can disrupt just software as strictly defined is probably going to broaden out to it also can affect other service type companies, healthcare being one of the areas that's going to get some scrutiny, I think. For what it's worth, some of the banks that have specialty lending groups related to healthcare. By the way, in this report, I do show what the healthcare exposure is for banks. It's about 3.5% of the total loans. It's not a huge outsized exposure for commercial banks, but there are some banks that have specialty operations. Probably the best known is Live Oak Bank, symbol LOB. And it's something that one should go take a look at. First Bank of Colorado, which was recently bought by PNC, also has a specialty healthcare lending facility. Fidelity Bank, symbol is PDGC in Pennsylvania, and Bankwell, which is BWFG of Connecticut. So they're in Connecticut. These are all banks that have specialty healthcare, and Capital One also has a specialty small business healthcare lending portfolio. So, these bear watching and monitoring, because I think that's the next area beyond software that is going to start to show some problems.
All right. Bob, you got anything else for us today before we sign off?
Hi, I'm David Maris. If you like what you just heard, we've tracked every single pick we make on the show, every ticker, every thesis, every entry price, over 1,100 picks and counting. We put it together in a free report with our top 10 performers, the reasoning behind each one, and a preview of our full dashboard. If you want access, the link is in the description.